Welcome to our latest explainer. Today, we're taking a look at one of the absolute cornerstones of the modern world, financing. Whether you're just starting to map out your personal finances, or you simply want a refresher on how money actually moves behind the scenes, you are exactly in the right place. We're going to demystify how financing works, why it even exists in the first place, and the different forms it takes in our everyday lives. Let's dive right in.
So, here is our roadmap for today. First up, we'll hit the basics of financing. Then, we'll look at how interest actually works. After that, we'll walk through 3 common financing types. And finally, we'll break down secured versus unsecured loans. All right, Section 1. The basics of financing. Specifically, borrowing money.
Let's be real for a second. Have you ever wanted to buy a car or a house, but you just didn't have enough cash sitting around? It's a hugely relatable situation, right? I mean, pretty much everyone faces this exact dilemma at some point. You've got this big goal, a major purchase you really need or want to make, but your current bank balance just doesn't quite cover the price tag. Well, that gap between what you want right now and what you can literally afford today, that's exactly where financing comes into play. At its core, financing simply means borrowing money from a bank or lender to buy something today and then paying it back over time, plus interest. Think of it as a tool. It bridges that gap we just talked about. Basically, you're using someone else's money to make a purchase in the present with an agreement that you'll pay those funds back on a set schedule. But as you'll see in a minute, giving you that upfront cash definitely isn't a charity on the bank's board. So, how does this look in the real world? It usually happens in 3 distinct steps. Step 1, you go to buy the item today. Step 2, the bank swoops in and transfers the money directly to the seller for you. The seller gets paid in full right then and there. And then, step 3, you now owe the bank and you start paying them back, usually following a pretty strict monthly calendar. It's a very structured flow of capital. To make this a bit more concrete, imagine there's a bike you really want, and it costs $2,000, but you've only got $500 cash on hand. So you're exactly $1,500 short of being able to just buy that bike outright. That $1,500 gap is the crucial number here. With a financing agreement, a bank will step up and lend you that exact remaining amount. And because they fronted that $1,500, you get to ride the bike home today. You don't have to wait months saving up the rest of the cash. You get it now. And in exchange, you agree to chip away at that balance with the bank every single month. Moving on to Section 2, how interest actually works, aka the lender's fee. Remember when I said this wasn't a charity? Well, interest is simply the lender's fee. Banks are businesses, right? They don't just hand out money for free. They make their money by charging you for the actual service of providing that upfront cash. So along with the original amount you borrowed, which we call the principal, you also have to pay them this extra fee over time. That's essentially the cost of getting what you want today instead of waiting. Let's look at the math in action. Say you borrow $100. If your loan has a 6% annual interest rate, you aren't just paying back that original $100. After 1 year, you're actually going to repay $106. That $6 difference, that's the interest. It's the lender's profit for taking on the risk of lending to you and for parting with their own cash for a year. That basic mechanism is exactly why lenders are so willing to finance your purchases. All right, Section 3, 3 common financing types. So how does this play out in everyday life? Well, let's walk through a few common use cases. First up, credit cards. This is highly flexible. You essentially borrow as you spend on your daily or monthly purchases. Next is a mortgage. This is a massive, highly specific type of financing used pretty much exclusively to buy a home. And finally, you have personal loans. This is typically a lump sum of cash handed to you for things like education, travel, or maybe some home improvements. Obviously, different financial needs require different financial tools, but that underlying concept of borrowing and paying interest, that stays exactly the same across all 3. Which brings us to Section 4, secured versus unsecured loans. Now, let's compare these 2 concepts because they are absolutely crucial. First, you have secured loans. These require collateral like your car or your house. That means the loan is backed by a physical asset. Because of this, if things go sideways and you don't repay the loan, the lender has the legal right to literally take that asset away to recover their money. On the flip side, we have unsecured loans. These don't require any collateral at all. The bank can't just show up and take your house if you miss a payment. But, and it's a big but, because the lender is taking on way more risk by not having an asset to seize, they'll usually require you to have a really strong credit history to prove you're trustworthy. Plus, to offset all that extra risk, they're generally going to charge you a much higher interest rate compared to a secured loan. So it's all about balancing risk and reward for both you and the bank. To bring it all together, let's zoom out and look at the ultimate value here. Financing helps people buy important things without having to pay the full amount upfront. Whether we're talking about that $2,000 bike, a college education, or a family home, financing is a seriously powerful tool. When you actually understand how it works, how the money moves, why interest is charged, and the risks tied to different types of loans, it becomes a highly effective way to manage your life and hit your goals. I want to leave you with this final piece of advice straight from our source material. Borrow wisely, understand the interest, and always repay on time. You see, financing isn't free money. It's a strategic agreement. So, as you look at your own financial goals moving forward, ask yourself a question. Are you using financing to build the life you want? Or are you just letting the cost of interest build up against you? Thank you so much for joining me for this explainer, and keep learning.